hi, Mr. Money.
Hello, John. And how are you today, Judy?
Just great.
You remember our learning machine over there?
Well, sure, that's a great gadget.
What's it going to teach us today, Mr. Money?
I'll turn it on and you'll see.
Welcome to Forex Trading Basics. Now, before we get into any details about trading in the Forex market, let's begin with a basic understanding of what Forex is and why it exists. The word Forex is basically short for foreign exchange, or to be more specific, foreign currency exchange. You may see this further abbreviated as the letters FX or the number 4 and the letter X. This exchange is the world's largest market, because it's the place where most of the world's currencies are exchanged for one another. Recent estimates of the size of this market report an average trading volume of about $4 trillion per day. By comparison, the New York Stock Exchange has an average daily trading volume of just $4 billion, and in recent years has been well below that. So why is this market so big? Well, simply put, the Forex market is a network of thousands of banks and millions of traders all over the world, all of which are constantly attempting to determine the fair value of currencies in relation to each other in order to facilitate global trade. This may sound a little complicated, but it's actually not. Anytime you've purchased something that was made in another country, you've indirectly participated in the Forex market, because you purchased the item in your own currency, while the manufacturer of that product was paid in his or her own currency for this item. The only way to know what the value of one currency should be in comparison to another is by looking at the exchange rate. And the way this exchange rate is determined is through the market's determination of this rate in the foreign currency exchange. So you see, the way a currency is priced is in relation to another currency. Therefore, when traders trade currencies, they're trading a currency pair, or more simply, they're betting that one currency will increase or decrease in value in comparison with another currency. So, for instance, let's say we were considering trading the British pound against the Japanese yen. If the pound were to increase in price, then the yen would be decreasing in price by exactly the same amount, and vice versa. Now, you may be wondering why currency prices move. The underlying cause of a price movement in any market is typically based in the fundamentals of that market. So, for many markets, the focus is on supply and demand, as free market forces determine what is considered to be either expensive or cheap, depending upon how much of the item is available and how badly someone wants to buy or sell it. Forex markets are no different than any other market in this regard, because the supply of a currency and the demand for it are certainly a concern when determining a value for a currency. So, for instance, if lots of people all over the world wanted to buy American goods, then they'll need US dollars to do it. And this demand for US dollars would have a positive impact on the value of the US dollar. However, Forex markets actually go far beyond basic supply and demand figures. Everything that affects the political and economic situations of the two nations involved in a Forex currency pair has some bearing on the value of the two currencies against each other. Now that we understand why this market exists and have a basic understanding of how it functions, let's talk about who has been trading in this market and why someone might want to trade Forex in the first place. At the present, there are still a lot of people out there who have certainly heard about stocks, bonds, options, and even commodities, but still haven't heard about Forex. This is simply because, up until rather recently, the average person could either buy stocks or bonds through their broker, but couldn't trade currencies, because there really wasn't a means to do so. Whereas many of the world's largest banks, hedge funds, and insurance companies have all actively traded currencies with each other for profit for many years. This has all changed with the explosive growth of the internet and the use of the personal computer. With the expansion of the use of the personal computer in households all over the world, the Forex market has finally become accessible to anyone with an internet connection, and as a result, the news of the opportunities this market holds is rapidly spreading to all corners of the globe. And because there are some fantastic benefits to this market, like the fact that it's a 24-hour market rather than the stock market with its more limited trading hours, or the fact that there are just a handful of major currency pairs to evaluate compared to thousands of stocks, the popularity of Forex trading is exploding. So now that we know a little more about the Forex market, let's pop open the 4X-DAT software and take a look at some currency pair quotes so you have an idea of what these look like. Here in the quotes module of the 4X-DAT, we see a list of major currency pairs and the various quotes for each. Let's just pick a pair and take a look at what the quote tells us. The first thing you'll notice is that there are two values noted for this pair. The price on the left is known as the bid price, or the sell price, while the price on the right is the ask price, otherwise known as the buy price. So obviously, these are the prices available to you based on whether or not you want to buy or sell the pair. The next thing you'll probably notice is the fact that there is a difference between the price on the left and the price on the right. This difference is known as the spread. Simply put, the spread is the fee that Forex brokers charge in return for facilitating the trade through their network. This brings us to our next and most crucial term, the pip. In its most basic sense, the pip may be described as the smallest unit of movement in a currency. You'll note that the spread we were just looking at is equivalent to 0.0003 of the currency. This difference would be called a spread of 3 pips by currency traders. Since most major currency pairs are priced to 4 decimal places, the smallest change is that of the last decimal point. For most pairs, this is the equivalent of 1/100th of 1%, or 1 basis point. There is one exception to this, however. The yen is actually quoted only to 2 decimal places. From here on out, you'll be hearing a lot about pips, as currency traders are trying to capture as many pips as possible in order to profit by trading currencies. Let's briefly go over some figures to illustrate why someone would want to trade currencies when, on the face of it, it looks like currencies don't change very much in the course of a day. Let's say you're trading with dollars and you want to buy 10,000 euros. Let's also say that the current quote for the euro versus the US dollar is 0.7415. This means that you would have to spend $13,486 to buy just 10,000 euros. This is calculated as follows. 1 euro divided by the exchange rate equals the amount of dollars needed to acquire 1 euro. Then we multiply this by the amount of euros we want, and we get the amount of dollars this will cost us. Let's now say that while we were doing this calculation, the exchange rate for the dollar versus the euro increased by just 1 pip to 0.7416, thus increasing your buying power and reducing your cost. So now the calculation is as follows. If we look at the difference between these two calculations, you've saved $1.82 on this transaction from a movement of just 1 pip. Still doesn't sound like a lot of money, does it? Okay, well here's where things actually get pretty interesting. The US government permits leverage in the currency market of 50 to 1. In some other countries it can be as high as 100 to 1. So let's just assume you're a US citizen and you've leveraged your position at the rate of 50 to 1. Now this 1 pip move means a total difference of $90.93. Now consider this. The average daily range for this pair has been well over 100 pips over the last few years. Assuming an average daily range in price of just 100 pips, this would mean that the possibility exists for a trade like this to yield as much as $9,000 in a single day. Now, trying to make a trade like this carries a lot of risk, because the market swings both directions, and leverage will multiply your losses as easily as it will multiply your gains. So understanding money management and strategy is critical to any trader's success. But this illustration shows why people are finding Forex to be an incredible opportunity. Additionally, this illustration really only shows how one would make money when the market for the dollar against the euro is increasing. This would be referred to as going long on the US dollar-euro pair. However, if the market were going the other direction, we could place our trade to short the dollar-euro, or any other pair for that matter. We at 4X-DAT employ not only a number of money management strategies, but also a number of trade entry and exit strategies and some pretty incredible trade management strategies once our trades are open. We build strategies in the 4X-DAT software to go long when the market is on an upswing, and to go short when the market is headed downward. We can place lots of smaller trades and build our way into a position, and we can place orders to protect our trades once they hit profit targets. This way we don't have to completely close these trades in case the market makes stronger moves in our direction than we even anticipated. And if the market turns against us, we can employ a number of different strategies to minimize our losses and even turn a losing trade into a winning overall trade sequence. I know what you must be thinking. How can we possibly manage to keep track of all of this? Quite simply, we do it automatically. That's right, we set up our strategy, and then we let the software trade it for us, thus eliminating not only hours in front of the computer waiting for the perfect setups to occur, but also eliminating a trader's worst enemy, his or her emotions. The 4X-DAT allows us to plan our strategy in advance and execute trades when the timing of the market is just right. Remember how we said that the Forex market is a 24-hour market? Yep, you guessed it. The 4X-DAT executes our trading strategies while we sleep, while we're golfing, while we're on vacation, and while we're out spending time with our friends and family. There's simply nothing else quite like this software. You'll just have to see it for yourself. Well, hopefully this video has shed some light on what we at 4X-DAT hope will be a huge opportunity for you to take advantage of the opportunities that the Forex market offers. But more importantly, we hope you will soon find that the best way to trade this market is with the 4X-DAT. We know that there's a lot to digest when it comes to learning about an opportunity like this, and we certainly know that we can say a lot of things about what our software can do, but as the old adage goes, the proof is in the pudding. So we're more than happy to offer you a taste. Simply head on over to the results page of our website to see the results of 6 accounts we're currently trading live automatically through the 4X-DAT. And then, if you'd like to see even more, you can actually watch the 4X-DAT trading these accounts live by simply completing our free registration. We provide an unbelievable amount of information on our site as well, including 8 free tutorial videos to explain the inner workings of the 4X-DAT. So we encourage you to explore our website to learn more. We at 4X-DAT wish you all the best and great success in your new venture. Thanks for watching.